looking to join their counterparts at Morgan Stanley and Bank of America, Goldman Sachs throws in the towel, saying the bear market bottom has not been reached. What does it mean for markets? And more important, what does it mean for you? Welcome to the Money Runner. It's Wednesday, September 7th. This is your Market Minute. I'm David Nelson. Based in London, Goldman's Peter Oppenheimer put out a research paper this morning with the title Bear Repair, the Bumpy Road to Recovery. When I saw it, I hit the print button. 2 minutes later, it was still printing. It's 45 pages of charts, graphs, tables, and research looking at bear markets from the early 1800s to today. So it's no small undertaking. This is where the underbelly of Wall Street starts to show. It's important to note that large investment banks often have competing teams of research with opposing points of view. On Monday, Goldman's Jan Hatzie, as chief economist and head of research in New York, put out a research paper titled Progress Toward a Soft Landing. Maybe not entirely bullish, but certainly not the bearish view penned by his colleague in London. It's easy for Goldman to be on the right side of history if you come out with two opposing viewpoints. One of them's got to be right, and you chalk up another win. Look, I'm on record saying that June was the lows for this year. The very minute I'm wrong, I'm going to have to come on this pod and talk about it. Since Jackson Hole, markets have aggressively sold off as investors have used any early morning bounce to reduce exposure. Bottom line, equity investors believe Jay Powell when he says higher for longer, and there's building fear that rates will go high enough to snuff out any growth and in fact put us into deep recession. I've been taking the other side of that call, pointing out that bond investors aren't buying it as Fed fund futures still point to a terminal rate only slightly higher than pre-Jackson Hole and still looking for cuts in the back half of 2023. In fact, I pointed that out yesterday in my interview with Fox business anchor Maria Bartiromo. You know where I stand. Let's examine the talking point repeatedly made by the bears. Current earnings estimates for the S&P 500, look at this chart, this year is $226. They want to give it a 10% haircut, putting it at about $200. Put a 15 times earning multiple on it, and you get this. 3,000 would be about 23% lower than current levels and would likely give you the extreme positioning that Goldman's Peter Oppenheimer is looking for. The one area of agreement I have with Goldman is the following. The next bull market is going to look a lot different. Rising globalism was often viewed as a positive in past cyclical turns, but this time it's everyone for themselves. Today, globalism is dying as the United States look to onshore supply chains and recognizes that some of our largest trading partners are an adversary in every sense of the word. You know who I'm talking about. As always, please hit me up with comments on the pod. What do you think? And more important, what would you like to see to make it better? And if you like it, please hit subscribe. That helps too. I'll see you again tomorrow.